Alright, hey, on this video we're going to discuss a little bit, like just kind of take a step back and think about the portfolio optimization things we've just done. And think about just like the benefits and views of doing it this way, and the alternative kind of, you know, obviously there's a zillion different ways to do portfolio optimization, but I'll just show like one standard thing. So if I just open up a new tab and do like mean, variance, frontier, this is a pretty standard way of people thinking about, portfolio optimization, right? So what what this is the risk-free asset, and these are a bunch of like equities or stock assets you could have. And then really what you want to do is you just go somewhere along this line. So really all it is there's this portfolio here that's tangent, and then you allocate between this tangency portfolio and investing in this risk-free asset. And really the whole question is, where do you want to lie along this line? Okay, but so first of all, this assumes there's a risk-free asset and a lot of a couple other things. So and that's fine. I personally don't like that much, and I'll actually get a little bit more into that in the next video. Why I don't really like that as much. But so let's just look again at the activity we made in the last video. I'm just opening up in GeoGebra. Okay, so here, instead of the question of portfolio optimization being where along this line do you want to lie, and being the expected return versus the variance, really all we're doing in this sort of framework is saying how many of these assets, basically our goal is to create some synthetic asset, some synthetic payoff, right? Given these two payoffs, right, or given these two assets, we can get anywhere on this plane, and with our given initial wealth, we can only get anywhere on this line. So the question is, where on this line do we want to go? Like, what is our synthetic payoff we're going to get by buying and selling or trading these assets to get to our optimal location? So it's sort of a different way of thinking. This one, the goal in portfolio optimization is to create your favorite synthetic asset, to create your favorite synthetic payoff, where favorite being defined by your utility function. And then here, all you're doing is, just allocating between, the risk-free rate and this tangency portfolio. So I've kind of grown to like this way of doing it. I think it's maybe a little more interesting, maybe a little more general. I don't know. There might even be just like a one-to-one correspondence between them. But yeah, so I wanted to mention that, and then mention that this doesn't really care about risk-free assets. Of course, if we make our utility function very risk-averse, we're going to end up somewhere right here. And again, that's something we'll talk about a little bit more. And then there's one other thing that I wanted to mention here, is that what if you can't short sell? What if you can't, like, our optimal scenario over here was taking out a loan for this 8.36. What if you can't take out a loan at an equal rate as to what you can get it out? Or what if you're not, I would say, what if you're not comfortable taking out loans, but your utility function says you are? So, but in any case, what if you can't get it quite right? What if you really only can just allocate between these two assets? What if you really only can get money at this rate and invest in stocks at this rate? Well, then what happens is this line basically continues. So let's draw a line here from this one to this one, and then this one to this one, right? And so what's happening is this right here, this intersection point, is the riskiest, highest expected value return you could get, and this right here is the most risk-free one. So depending on your risk aversion, right, all you can really do is get this far along the line. Let's say you're fairly risk neutral, as is shown in this utility function, and your optimal scenario is being over here, but it's like, well, I can't get there because I'm not allowed to like short sell. I'm not allowed to like take out loans very efficiently. So really, all I can do is get over here. And so this would be your optimal scenario because it's as close as you can get to this thing. And then of course in the risk-free rate, when you're super risk averse, you actually can get there just by putting money under your pillow. So this is the case where you're very restricted on what you can do. But of course, if you're not restricted, you can just kind of go free and these things don't apply and you can get all the way over here. And that would be if you take out loans to get levered and get yourself more money to invest. Okay. And then in the next video, we're going to talk about a little bit about change of numeraire, and I'll kind of comment on why I kind of think risk-free assets are a little bit of hogwash, but yeah, you'll see why in the next video. So thanks.